Welcome back to the What Does It Mean podcast. I'm Lindsey Bell, and I'm here with my co-hosts Chris Versace and Bob Lang, who I am pretty sure spent the weekend eating cake to celebrate the Bulls' second birthday. Am I right, guys, or am I right?
Pie, Lindsey. Always pie.
Pie. Yeah, so this thing's 2 years old. What do you think, Bob? What are the technicals? Is this thing going to last?
Well, as we wrapped up a real strong month of September, we started off October pretty strong, and the past statistics look real favorable for the Bulls into the fourth quarter, into the end of 2024, when the market has been up 20% after the first 9 months of the year. I want to say it's been 6 times. Every single time the market's been up a lot into the end of the year and finished very, very strong. Now, obviously, as we get started in 2025, 2.5 months from now, it's going to be a whole different story. But I certainly think the tailwind here is at the back of the Bulls here into the end of the year. Seasonal trends are very bullish as well, too.
How do you feel about it, Chris? Does this bull market got more legs?
I think it's got some additional legs. I say that in part because I agree with Bob. You know, if you look back at some of the data that Bloomberg has published, looking at the various months and how they performed over the last several decades, you know, October, November, December, there's a lot of seasonal strength there. I think, though, we're going to have to get through the earnings season. You know, expectations are a little mixed. And, you know, as we're talking today, I noticed that one company in particular, United Health, is getting punished after resetting its 2025 expectations lower. And you guys know that I've been really concerned about that mythical 14% growth for S&P 500 earnings next year. It's one of the highest numbers we've seen in some time. And yeah, I get the fact that the economy has been holding up. I get the fact that the Fed is going to be cutting rates, but that is still a big double-digit number for so early in the process.
Hey, but I don't think you could call it mythical because that is actually the consensus estimate.
No, I'm calling it mythical as in it's out there in the ether, but has anybody really seen it? Anybody touched it? Anybody smelled it? It's a lot of thought, a lot of sizzle, Lindsey. We don't know if they're steak yet.
Fair enough. But what I will tell you is that this bull market is up 63%-ish since it began in October of 2022. And you know what? When it hits this point, usually it's a good sign. Like Bob said, you can see this bull market run for another 2+ years. That has been the historical trend. So that being said, the third year can be pretty rocky. And I think we're going to talk about a couple reasons why that's so in today's episode. We're going to cover activist investor influence. We're going to talk about earnings season, which Chris just mentioned. And we're going to talk about the impact of the election on businesses. So stay with us. We'll be right back after a short break. Welcome back, everybody. We are back in the pod, and we're going to dive right in, Bob. Let's talk about this activist influencer, the activist investor influence on companies and shareholders. There's a lot of activists out there this year. I think you pulled some data from Lazard, and we're up 29% compared to the historical 5-year average. On a global basis, the U.S. isn't up as significantly. But what's the buzz? Why is activist investors, why are they on the radar these days?
Well, let's step back and try to understand why an activist investor would get involved in a company. They obviously see a misallocation of resources, underutilization of people and processes in a business that they think is probably much more superior than they've been showing in terms of their stock performance. So an activist investor wants to get involved when they feel that they can have some influence or make an adjustment in the board of directors or the CEO, perhaps other management team members. I looked recently at stock of Southwest Airlines, which has been struggling to keep pace with much of the other airlines. And in fact, Southwest, is by market cap is the largest airline out there, but they've still been struggling to catch up to the likes of Delta, American Airlines, and even United Airlines. So an activist took a position in the company very recently, and that made some headway, especially within the C-suite there. I think that activists are there generally to help themselves, but also to help other shareholders as they try to extract some value, that's hidden value that's in the company. going forward. But I think activists are good and they're somewhat positive, but I think the jury is still out on what their motivation is.
Yeah, I think motivation is a good point. I will say from a price perspective point, Goldman Sachs did some research on this, and they found that over the years, these type of campaigns, they have been mixed. And what you usually see is a quick pop initially when the activist investor gets involved, the announcement is made. You see about a 3% pop the week after the launch, but longer term, it's kind of muted, the performance. And so it is a question is what their motivation is. Chris, what do you think? The other thing I'll note too is, going to you, Chris, is that usually these investors, they pick companies that are good companies but have lost their way. And to Bob's point, some of these investors are looking at tech stocks lately.
Yes. So, it's kind of interesting. I was listening to you guys chat about this, and I was almost going back to what we used to see back in the day, 80s, 90s, private equity, dust off your den of thieves, dust off your barbarians at the gate, where private equity would kind of come in, strip costs out, realign the business, and then ultimately take it public or sell it. But the whole idea of cashing in on the work and the investments that they put in to that particular company. And today now, you've got this happening with public companies like you guys are talking about, but it's hedge funds that are involved. Not mutual funds. You certainly can't do this under the ETF wrapper, but it's hedge funds. And they tend to be more aggressive players. And I think Bob hit on something where from their perspective, they're trying to unlock value. I think the question, though, is, are they trying to unlock value in the stock and their position? Or are they really trying to unlock value in the business over the medium to longer term? And I think that's where the jury's really out. Because if you think about how someone who comes in, strips out costs, does those types of rationalizations, headcount rationalizations, all they're concerned about is driving the EPS higher and getting that pop in the stock. Most hedge fund guys are not operators. So how much insight they truly bring to an airline, to a media company, I think it's questionable at best.
Hey, don't tell those hedge fund managers that they're not operators, though, Chris. Some of them think that they are, right, Bob?
Oh, I know. Look, and I realize that that's kind of a sweeping statement. There are some extremely smart people in there, but not everyone is an expert in every industry, either when it comes to picking the stock or knowing the nuts and bolts to actually run the business.
I agree. Like one data point that I noticed was that a lot of these activist investors are generalists, or they're offshoots from the big activist investors too. They are leading the way. So I think you make a good point, Chris. And Bob, you had something you wanted to add.
Yeah, I'd say everyone should know that the ultimate activist investor is Warren Buffett, who comes in and finds these companies that are valued much lower, maybe underpriced. And I think a lot of hedge funds these days that Chris alluded to are trying to use that angle and try and parallel along with Warren Buffett and trying to find some companies that are on the cheap. Maybe, and again, like Chris said, they're not necessarily trying to operate the company. This isn't Carl Icahn trying to take over TWA. This is more companies like Elliott Management who see an opportunity as stock is selling at a much lower multiple than they normally would be trading at, or even less than the sector that they're in, finding an opportunity to make a 25-30% gain on the stock and then probably dumping it when they're feeling confident that they've done their work. But, if you have the wherewithal of a Warren Buffett to go ahead and jump in and buy a company and his timeline is forever, well, then I think that sort of an activist investor is very useful for shareholders, at least for the long run.
Yeah, Bob, I have to say, Warren Buffett's an interesting example. He gets quoted or thought about, I should say, about a variety of things across the investment landscape. But when you really break it down, granted, the size of the portfolio that he has inside of Berkshire Hathaway is large. But when you break down the company's profit stream, the investment portfolio is not the biggest piece, far from it.
He's a long-term activist investor, I guess, is what you can say, right?
That's right.
We did talk, though, fellas, about this CEO turnover a few weeks back. And this ties really into this activist investor storyline, because what you are seeing is there's an increased level of CEO turnover when an activist comes in. And more so recently, there was a research done by Barclays, 21% of targeted companies see their CEO resign within a year. That compares to a 12% average over the last 2 years. So it's no surprise. And, I think when you look at what other folks say about CEO turnover, it happens in period of economic uncertainty. It happens in periods where companies are pivoting to new procedures, new operations, maybe new technology, offering new products. And I think it also, once again, is another data point that just speaks to the day and age that we're in. As a company, it's much more difficult to operate. There's an increased level of focus on expense control because of the uncertainty about the future. It's also why you see margins expanding to pandemic level highs, which are well above historic highs. And so what do you make of it all, Chris?
I'm kind of wondering, Lindsey, as you're talking about that, the focus on cost cutting, it also kind of ties with every, I guess, CFO saying that their new favorite, I'm going to make sure I don't botch this word from The Godfather, their favorite consigliere is AI, because it can really help them drive cost out of the business and identify where there's excess cost in the business. So, it's kind of interesting.
I would also add there that in terms of controlling costs, let's face it, some of these CEOs are getting paid a lot of money, not just cash compensation, but also with stock compensation. And if these boards are willing to take a chance and take some risk and pay these guys a lot of money, they have to perform. And if they're not going to perform, somebody's going to come in there and with suggest some sweeping changes and saying, hey, look, you're not doing it. This is what happened with the CEO from Nike, we talked about. This is also what happened with the CEO from Starbucks and a couple other companies as well, too. If they're not going to perform, then somebody's going to come in there and point that out. They can't hide behind the board of directors any longer, which back in the day, that used to be the case. I mean, maybe Elon Musk can hide behind the board since he's basically chosen everybody who's on that board of directors. And when he gets a compensation package of $55 billion, look, the guy earned it. He made a lot of shareholders a lot of money over that span of time, the 6 or 7 years when this compensation agreement was first written out. He hit his marks, but there's some CEOs out there that don't. And if an activist comes in there and starts pointing fingers at, why isn't the performance doing well for the stock? Well, those fingers are going to be pointed right at the CEO.
But that doesn't mean that just because a change comes in, that it's a change for the positive. Again, take a look at Starbucks. They brought this guy in who clearly did not know the business. He was from a totally different business altogether. So I think you really got to be, when you're looking to invest in companies that are the target of a activist, I think you need to understand who the activist is, what their investment strategy is, what their track record is, and who they want to bring in to help run the business. That's really going to tell you whether or not this is a short-term pop in the stock. Thank you very much. Wham, bam, thank you, ma'am. Or is it going to be a more protracted fix for the business that I think most investors would like to see?
And you know what, Chris? I think you did an amazing job of summarizing that. That sounds like the bottom line there. What does it mean? You did it. Right?
And unprompted.
And unprompted, too. So with that, it takes us kind of to our next subject. We talked about margin expansion and how that could potentially be of a focus of an activist investor. But it's earnings season. It kicked off last week with some of the banks. Woohoo! Right? Best time of the year.
Little dance party here.
Little dance party from Chris, for those who can't see it. So earnings season, third quarter, we're looking for earnings growth. I use Capital IQ, S&P Capital IQ numbers, 3.1%.
Of course you do. Of course you use those guys.
Yes, that's my background. I worked there for a long time and analyzed earnings for them for a really long time. So this is a topic that's near and dear to my heart, right? Well, that's a sharp decrease, Chris and Bob, from the double-digit earnings growth that we saw last quarter, which was the first double-digit growth quarter, by the way, since the fourth quarter of 2021. So that would be a pretty significant drop-off, right? And this is in a period of time, Chris, I'm just going to give you a quick setup. GDP is expected to be above 3% in the third quarter. I know the Citigroup Economic Surprise Index was negative for most of the quarter, but it's moving up now, right? And within the quarter, we did see solid consumer spending, even though, Chris, you and I weren't expecting it. There was a strong service sector. There's moderating inflation, lower gas prices, lower commodity prices that fuel the consumer, right? And so 3% growth, it just feels really, I don't know.
Low?
It feels like a low bar. Am I crazy?
No, I was actually reading something about this morning, that there's some folks out there who are in that camp. The way I kind of come at it is slightly different, Lindsey. I do not follow S&P Capital IQ. I'm a FactSet man. And as Bob knows, I religiously track the quarterly expectations published by FactSet every Friday in their earnings insight. And what I'm always looking for is year over year, but second half of the year compared to the first half, second half of the year now where we are compared to the year ago, period. And what's interesting is as of, I think, October 4th, so there might be some wiggle room here, expectations for the S&P 500 earnings in the second half of the year were only expected to grow 6% compared to the first half. Compared to July, you guys, that's down from over 11%. That's a big revision lower. Yet, the market continues to melt up. So I think to tie in what we were talking about earlier about the bull market continuing, if we want to see some of these numbers that are out there, I think UBS is saying 6,200 on the S&P 500 by the middle of next year, something like that. We're going to need to see that earnings growth kick in and kind of bring that S&P 500 PE multiple down, because with the revisions that we've seen for the back half of the year, it's over 24 times. And that's 24 times expected 2024 earnings, again, which have been coming down. But there's only three times we've seen the multiple above that in the past. During the pandemic, 2001 and 2002. 2001, S&P earnings fell double digits, and 2002, not much of a change there. So if that's your benchmark and you're arguing, wow, the market multiple can go higher, you're crazy. You are crazy. So, and to your point, Lindsey, let's think about the environment, right? Earnings expectations are expected to grow, a little slower, but still grow. That's not what we saw in 2001, 2002, or during the pandemic. GDP, very different environment compared to back then. And the Fed's on a rate cutting cycle. So I just don't see it. So I too am concerned. I think there might be a low bar. The question is, how low of a bar? Is it a limbo bar that we can walk under, Lindsey? I don't know.
You never know until you get into the heart of it. What I will say is, like I already said, we're at the very beginning of this period. Numbers have been really, really strong, but I will tell you, they always start off really, really strong. We're in the 74, 75% beat rate for all these companies on top and bottom line. So that will come down. That's going to come down. The banks have done exceptionally well. The big banks that have come out, it's really been driven by a few things. Investment banking revenue has been better than expected. Trading revenue has been better than expected, which surprised me because I'm like, hello, the market was up. There was volatility. The banks benefit from this stuff. I don't know why this is a surprise, but I still think.
Wait a second. Wait, you say that. I'm not surprised. That's why we own Morgan Stanley and Bank of America in the Street Pro portfolio. Come on, Lindsey, give me some credit.
I know we like the bar to be lowered, right? And I do think, Bob, I think that we owe Dan Pinto at JP Morgan credit for lowering the bar, because in early to mid-September, he was at a conference and he talked about how net interest income was, expectations were unreasonable, I think was the word that he used. Same for expenses. So, not only did he beat, the company beat on those numbers, but they also raised guidance for their outlook on those numbers. And then we also saw the majority of the other banks also beat on those numbers. So
it makes it so much easier for us to be right when they lower the bar so much, right? And that's all that matters, right? We just need to be right. We don't have to get the timing right. We just need to be correct. And I think even when they lower the bar, Lindsey, what I find it fascinating is the market still has to climb a wall of worry. There's still that wall of worry up that people are unsure of. Well, you know what? They lowered the bar on these. Maybe there's another reason for this. Maybe there's something that we're not seeing that they're seeing. And when the market has to climb that wall of worry, that's usually very, very bullish and positive for results and performance of stocks going forward. What do you think?
Well, no, I agree, but I'm going to toss that to Chris, because he just talked about how he owns a couple of these big dogs. Where do they go from here? They're on a relative basis. You could say they're kind of undervalued versus where they would be at this part of the cycle, right, Chris? Is there opportunity in the banks?
Yeah, oh, absolutely there is. A couple things. When you say banks, I think we need to really understand that not all of these are built the same, right? Morgan Stanley is very different than Wells Fargo, PNC, right? So you really need it's a lesson of know what you own. So from my vantage point, been very interested in the rebound in investment banking, both IPOs and M&A activity. The pipeline seems to be very robust. And I think if we continue to see the bull market, like we talked about earlier, I think you're going to see those activities happen, especially as the Fed continues to cut rates. That'll lower deal costs, hurdle rates, all of that. So I think we'll continue to see that. But, at the same time, one of the reasons why we picked Bank of America is they are involved in those businesses, but they are also expanding their footprint, both in asset management and in commercial banking. And if you read through the company's earnings press release, they talk about the number of checking accounts they added, the number of bank accounts that they added, and all these others. Plus, they're expanding their physical footprint, which I think will bode well for more of that. So I do think that there's more room. But if you're simply looking at a company that all they do is commercial banking, I think it's going to be a little tougher.
I think you make a good point in bringing Bank of America up, because what we talked about, a lot of the capital markets businesses driving some of these big bank earnings. There's going to be regional banks coming out, smaller banks that are more levered to the consumer or small businesses. And what I did find positive out of Bank of America and Citigroup, not as solidly, but for Bank of America, their charge-off rate was flat quarter over quarter. Of course, it's still up solidly on a year-over-year basis, but they took a big increase in the first quarter of this year, and they basically have held that charge-off rate, which is basically an expectation of what they think they're going to have to charge off because the consumer or businesses aren't going to be able to pay back their loans or credit cards. And so it's held flat over the last several quarters. You actually saw credit card their loss rate up 3.7% in the third quarter, which was versus 3.9% in the fourth quarter. So to me, even Citigroup, like I said, it wasn't as good, but it was stable. And so I think that bodes well for the consumer, at least in the near term.
That's what I was hoping you would say, Lindsey. I was like, take all that Wall Street gobbledygook. What does it mean for Main Street?
I was also going to say that maybe one of the reasons why this market multiple is so high that Chris had mentioned was because of the anticipation that because a lot of consumers are going to be doing a lot of spending over the holiday. Jobs are plentiful. We've seen a good, strong jobs report, good, strong economy here up to the past couple of quarters. And why not? Why not take a little bit of risk out there and get on the risk curve and say, look, you know what? Why not believe and accept that 70% of the economy is going to keep moving forward over the next 3 to 4 months, and it's going to be a nice holiday season for everybody. Of course, obviously, if discounting is there, that's going to help out even more.
Did you guys see that Starbucks is starting to revamp its use of incentives? That they're going to start shrinking them? Bob, you're no longer going to be getting that BOGO deal through the app on the weekend.
Very disappointing, Chris. I'm shocked and stunned, but it was fun while it lasted.
I got all the stars, but I never redeemed them. So while I feel upset about this change.
Did I tell you guys, this is totally off topic, did I tell you what I got for my birthday?
Yeah, you told me, an espresso machine.
My days of going to Starbucks are over.
We've got a good one too.
We've got one of those as well too. We got one for our wedding gift, and it's a great machine. It's a lot of fun to put that out there and make some nice hot espresso. And
Bob, you look like a macchiato man.
No, I'm straight espresso, Chris. Just that's me.
All right, I'm going to wrap up this earnings segment here.
Do it.
And so what does it mean? The takeaway is that the bar for earnings season is low, but they are going to need to come through and adjust the fourth quarter outlook, potentially get people to move their, like Chris said, their 2025 estimates a little bit lower because the PE is getting stretched. We need to see that we're able to beat and raise. And I do think that there's opportunity. If sales come in much better than expected, margins are going to be better. And I think that you'll see earnings grow greater than 3%. Maybe not double digits, but greater than 3%. But we'll stay on top of this topic, right, Chris and Bob, as it unfolds.
Like white on rice, Lindsey, like white on rice.
Absolutely. All right. Final topic of today's episode is the impact of the election on businesses. You know, there's a lot of anxiety and anticipation as we get closer and closer to November, right? But what we have seen is earnings growth is expected to slow in the third quarter, right? The question is that driven by anticipation of the election, the uncertainty that it brings? Or is it really just people are lowballing?
I would say this. I think the election as it is, it's a moment. It's a snapshot in time here. And once it's gone, once it's passed, once we're past November 5th, I mean, obviously there's going to be some fallout, a lot of emotions and so forth after this is over. But I think businesses pretty much are going to move forward. Again, it's just a snapshot here. And once they move forward, they're going to understand how this election result is going to reflect on their businesses. And I think there's a lot of companies out there that are hoping for a little bit more favorable tax situation if Donald Trump wins. Again, if Kamala Harris wins, it might be a different story. But still, I think as far as planning is concerned for the next year or two or three, I don't think the election is going to have as much of an impact at all.
Yeah, you know, if you look back at history, you do see around election time that companies will hold back CapEx spending on big purchases. But you have seen it in this year's numbers. The Q2 CapEx growth rate dropped to 4.2% from 7.2%. This is in GDP as of last quarter. I don't know what that's going to look like in the third quarter, but I do know that you hear a lot of companies, especially the tech companies, talking about spending on AI and that type of investment. And so I think companies aren't holding back on investments that they need to make to stay competitive. But what you do see, you contrast that to what's happening in the labor market, where I keep calling it a stalling out of hiring. Really, it's only replacement hiring that's technically happening. And then you think about what you hear from the C-suite, whether it's in the NFIB Small Business Survey or other sentiment surveys, and you could hear that the CEO and other executives are a little bit anxious about what the election means for the future. My thinking is maybe this is just kind of creating a bottleneck or pent-up demand that's going to be released either after the election or maybe in early 2025, because we don't know if the election is going to be settled, right?
I laugh, but that is my thinking entirely. I do not expect 11 o'clock on election night we will know what has happened. It could very well be a few days, you know.
Hopefully only a few days.
Pack up your supplies, head to the mountains, Lindsey, Bob, because you don't want to be around if anarchy strikes. No, all kind of kidding aside on that. I think what we've seen over the last couple presidential election cycles, I think it's fair to say that they've been very contentious, kind of uncertain, and very close. So I am not surprised that we hear companies saying, I don't know what's going to happen, especially with the polls being as close as they are, particularly in the battleground states. I think, Lindsey, that same NFIB survey you mentioned found in September a all-time high for uncertainty among small business. So the proof, as they say, is in the pudding. But I think when we kind of map it out, there are some things that I think will continue. I think infrastructure spending will continue. Defense spending will continue. There are uncertainties, Bob. I think you mentioned one, taxes. Obviously, that's a big question as to who wins. But the other thing we have to consider is it's not just whether or not Donald Trump or Kamala Harris are in the big seat, right? What happens to Congress? Whoever wins, do they have a highway to get things done, or are there just going to be a lot of roadblocks? That's going to depend on, what happens in Congress. And I think what's going to be confusing to some between now and Election Day, because it is so close, we're going to see a lot of advertising and campaigning media. We're going to get all sorts of promises that are tossed out there. But at the end of the day, we need to recognize that, these are campaign promises, and it's going to come down to what can they get passed through Congress. So I'm not surprised that businesses are feeling a wave of uncertainty.
Especially true for the tax situation.
Yep.
Because the tax policy passed in 2017 under Trump expires at the end of next year. And
That's right.
There's parts that were temporary, and there's parts that were supposed to be permanent, which was the corporate tax cut. But that doesn't mean anything, right? Depending on
No, it doesn't. Well, but think about though, Lindsey, right? Depending on who wins, you could be sitting there, and we were just talking about 2025 earnings expectations, but there are some folks out there who have modeled out 2026, 2027, whether it's for the S&P 500, check your buddies at S&P Capital IQ, see what they say, or for companies, right? You know, folks are out there with earnings expectations for NVIDIA and others out that far. They might have to really readjust those numbers depending on what happens in the election and the fallout on taxes.
What's interesting is that you mentioned the high of uncertainty index, the NFIB. It parallels what's happening in the markets as well, too. We have elevated volatility. Market volatility is around 21% right now, a little bit higher than we normally see it for this time of year, usually around the mid to low teens. As we move into the end of the year, we see a lot of volatility start to suppress. But right now, the uncertainty that's being reflected in small businesses parallels what we're seeing in the markets right now, especially in the oil markets and in the fixed income markets. We are seeing a lot of volatility there as well. So I think that the uncertainty about this election coming up is creating a lot of fear and a lot of anxiety, and people are going to sit back and wait and see how things unfold first before they make a move.
I think it's fair to say that there's other uncertainties out there, not just the election, when you think about the VIX, Bob.
Yep, I agree with that.
Yeah, there's geopolitical risks. There's still uncertainty what the Fed's exactly going to do and if they achieve their soft landing or not. But Bob, looking further out, when you think about volatility past the election into December, January, what does it look like going forward?
Well, going out past January, we do see some elevated volatility, but the term structure will likely get a little bit more in alignment. And what I mean by that is, I don't want to get too wonky in terms of the terminology here, but when the volatility term structure is in what we call contango, which means upward sloping bottom left to the upper right, that's generally speaking a normalized curve and means that the market can function much more normally. There's not a lot of fear or panic on the short end of the curve. And so I think that once we get past this election in November, December, I think that market's going to be much more normalized going forward. And I think in terms of volatility as well, too, unless there's some other surprise out there that we don't know about that tends to hit the economy or the markets or geopolitics, I think that we're going to be much more normalized in 2025 going forward.
Can I ask you a question, Chris? Like, what does this mean, though, over the next couple weeks? Do you hold your positions? Do you make any changes ahead of the election in anticipation of the election, or do you wait till the aftermath?
I think it depends on the positions you're talking about, right? So if you've got something involved in healthcare, for example, very dicey. I mentioned United Health earlier, but what happens with Medicare under Trump, what happens with Medicare under Harris can be a world of difference for those companies. So I think depending on what you hold, you have to kind of wait and see what the policy ramifications are. But remember too, though, we've got the earnings season going on, and there are certain things. You mentioned AI earlier, Lindsey. We could talk about data center demand. We could talk about a number of other things. I think the comments we get out of the earnings season will be more important for those other areas that are not as policy driven or policy at risk. That's what I would say.
I would also add, Lindsey, that the short-term volatility gets a lot of people anxious and nervous. But if you're a long-term investor, if your horizon is 10 years, 15, 30 years out there, these short-term blips and short-term drops in the markets are great buying opportunities. They present some great chances for you to get in there and buy stocks on the cheap, especially for the longer term. I know, Chris and I talk about this a lot with the Street Pro portfolio, that we're not really shaken too much by the short-term volatility of the markets. Rather, we're looking for opportunities if stocks get tossed out due to some heavy selling or for no particular reason at all. We're looking at opportunities to add.
I was just thinking that when Bob was talking about volatility coming down after the election, I was just going to add that like a day or two later, we've got the next Fed meeting, which will kind of help remove some uncertainty over the path of rate cuts for November, December
That's a good perspective. And hey, what we do know is that the dip buyers, they've been in full force when the dip opportunity presents itself, right? But that being said, you have heard last quarter and this quarter, again, getting back to the earnings topic, you heard some CEOs and CFOs talk about the election uncertainty. They kind of play it cool because they don't want to get too political, but they're kind of like hinting that it has weight on their mind. We heard, I think it was this week or last week, from Delta talking about the election impacting consumer travel, which I thought was a little bit interesting. You know, they think people aren't going to fly during the election period.
Oh, okay. That's interesting. I wasn't thinking about that. That goes along with what I said. Pack your bags, anarchy, right?
Chris says, everyone get on a plane. All right, Chris, wrap this section up for us. What does it mean? What does the election mean? What's the impact on actual businesses? And what does it mean for your investment strategy?
Yeah, it's going to be very close and come down to the wire. But I think you've got to check your investments, understand which ones are more policy impacted, like I said a few minutes ago. Check the data points for those that are outside. And we're just going to have to wait and see what the overall outcome is in Washington, you know, in the next hopefully 3 weeks, maybe closer to 4 weeks. And then we can kind of go from there.
All right. Well, we're going to take a quick break before we come back to wrap it all up. Welcome back. We're going to wrap up this week's episode of the What Does It Mean podcast. Bob, what was your biggest takeaway given all the wonderful things that we talked about today, from activist investing to earnings to the election's impact on businesses?
For me, Lindsey, I think the biggest impact on the show here was the surprising numbers about the earnings growth, and down to 3%, 3.1%, and following the Q2's double-digit earnings growth. So that is quite a sharp drop. And with the markets having gone up sharply over the past 5 months, it's going to be interesting to see how things settle out, and whether the market is going to start discounting those earnings out into 2025, because the market is way ahead of itself, as Chris said, with the higher multiple. So that's probably the biggest impact of the conversation we had this morning.
What about for you, Chris? What was your big takeaway? What was the most interesting thing we talked about?
Wow, so many things to choose from, Lindsey. If I had to narrow it down to one, I would probably say it was the activist conversation, and just kind of helping folks realize that there's a lot, there can be some smoke and mirrors involved with that. And you just need to understand, you know, what companies are being taken over, what proposed fixes are, what the time frame is, and whether or not it's a quick pump and dump, like I said. Because if you're buying a company on a hopeful fix, that could take time, and you really want to know what you're getting into.
I agree with you. That was my big takeaway too. It was just like, it was a really good conversation that we had, especially when you dug in and looked at the performance of a lot of these activists, especially now that, like you pointed out, we've shifted from the 80s and 90s from PE private takeovers, operating changes, to really what are kind of financial changes, whether it's M&A or even just a CEO change. We're doing the operational change. I think it's a different world that we live in, and it doesn't necessarily mean that you're going to make all the money in the world because some fancy, slick, rich hedge fund guru is pushing this stock.
Just remember, Lindsey, let the buyer beware.
Buyer beware always. Do your homework also, right? Well, That's going to wrap it up for this week, guys. Check the show notes and resources. You can find Bob at explosiveoptions.net. You can find me and my article, The Shift, at lindseybell.me. And you can roll over to the Street Pro portfolio to find Chris. Thanks for listening, and we'll see you next week.